Welcome. Today we learn options among derivatives, some of the most fascinating and some of the most dangerous. Options are not the same as futures. An option is a contract to buy or sell a right. Futures create an obligation. You must take or make delivery. But an option is a choice. Exercise or walk away. For example, coffee is $3 a cup. You buy the right to purchase it at $3 3 months from now. If coffee jumps to $4.50, that right is worth money. If coffee falls to $2, you simply don't use the right. Today's question, same index on the screen. Why does one trader make money while another loses? The secret sits in the Greeks and in volatility. Let's learn them together. Looking at SPY's daily chart on screen, let's learn the two basic option types, calls and puts. Call. You buy the right when you expect the index to rise. If SPY goes up, the call premium, the price of that right, usually rises too, so you can sell it for a profit. Put. You buy the right when you expect the index to fall. If SPY goes down, the put premium usually rises, so you can sell it for a profit. For the buyer, maximum loss is the premium you paid. You can't lose more than that, a big difference from futures. But the premium itself can spike with volatility. Think of that $3 coffee suddenly pricing like a $10 specialty drink. That's the trap in options trading. Watching SPY's daily on screen, let's learn the four forces that move option prices, the Greeks. Delta. If SPY rises 1 point, a call premium tends to rise somewhere between 0 and 1. Puts move the other way, -1 to 0. If SPY rises by 1 and your call delta is 0.5, the call only rises about 0.5. Track delta in your options analysis tools. Gamma. How fast does delta change? Even a small SPY move can create large P&L when gamma is high. Gamma often explodes as expiration approaches. Theta. How fast the option premium decays as time passes. When you buy options, the clock eats premium every day toward expiry. When you sell options, that time decay can quietly work in your favor. Time becomes money. Vega. If volatility rises by 1%, option premiums tend to rise. Higher Vega means more sensitivity to volatility. In a volatility spike, think of Fed Surprise Day. When this S&P 500 or Nasdaq whips around, Vega losses can get large, so stay alert. Looking at the VIX daily on screen, volatility comes in two flavors, what the market expects ahead and what actually happened in the past. Implied volatility, for how much does the options market think prices will move going forward? You back it out from option prices. Like the VIX, it can change minute by minute. Historical volatility, HV, how much did prices actually move over the last 20 or 30 days? It's the standard deviation of past price moves, fixed for a window, then rolling forward 1 day at a time. Textbook framing. If 4 is above HV, options look relatively expensive. The market is pricing bigger swings than the recent past. If 4 is below HV, options may look relatively cheap. That gap creates both opportunity and traps. Watch VIX on the chart and compare 4 versus HV yourself. Same underlying index, different option values depending on that gap. Look at the VIX weekly on screen. This is the fear index, a number built from 30-day implied volatility in S&P 500 options. A low VIX, about 10 to 20, means the market thinks conditions are calm, roughly a 10 to 20% annualized move expected over the next 30 days. A high VIX, about 30-50, means the market sees instability, pricing roughly 30-50% annualized volatility. History has extremes too. In the 2008 financial crisis, VIX hit about 89. In the 2020 COVID shock, it hit about 82. Find those spikes on the chart. You can feel how panicked the market was. When VIX rises, fear is showing up. When it falls, greed or complacency often is. Historically, a big driver is institutional hedging demand, buying put insurance when nerves jump. In crash or melt-up moments, thin liquidity and short covering can pile on too. In the US, you trade options on indexes and ETFs like the NASDAQ 100 on screen, or S&P 500 products such as SPX and SPY. For a standard equity or ETF option, one contract usually controls 100 shares, so if SPY is around $500, one call represents about $50,000 of notional. You don't put up the full notional. You pay the premium or post margin if you sell. That small outlay versus large notional is the leverage effect and the risk amplifier. Expiration usually clusters on the monthly cycle. Standard equity options expire on the third Friday, plus the quarterly cycle in March, June, September, and December. Weeklies are popular too, especially around Fed days. Watch this. Liquidity often concentrates in the nearest expiration. As that date approaches, moves get sharp, gamma risk jumps. Exchange volume stats make that concentration obvious. Near expiry, traders often close and reopen in the next month or rollover. Historically, expiration week can run hotter than average. Mass closing and arbitrage hit at once. It isn't always wild, but if you're unprepared, the P&L can get ugly. Check the calendar and your broker's expiration schedule ahead of time. Today's takeaway: options can aim for large gains with loss capped at the premium you paid, and they come with traps. High risk warning. First, premiums can spike with Vega volatility. Second, near expiry gamma can turn tiny moves into huge P&L swings. Third, in extremes there may be no usable bid or offer at all. If you sell options trying to collect premium, be even more careful. Buyers have a defined max loss. Sellers can face theoretically unlimited loss. This lesson is for education only. It is not investment advice. You are responsible for every trade you make. Next lesson, we cover gamma explosions and extreme expiration week scenarios. See you in T4.